Hi, this is Jay Hummel. Welcome to the Deep Dive podcast in partnership with Investopedia. Every time we come to a new episode, we always take listener feedback. And one of the questions we've been getting a lot is what in the world is going on with real estate, whether that's commercial, whether that's retail, whether that's multifamily. And I couldn't think of a better guest to have than Jay Miller, Chief Investment Officer of Forum out of Denver, Colorado. Jay, thank you for being on the show.
Great, Jay. It's great to be here. Also nice to be on a podcast with another Jay.
And just so everybody knows, in full transparency up front, I'm on the board for Forum of one of the companies that Jay's involved in. So doesn't mean I'm going to take it easy on him today, but just in full disclosure. Jay, why don't you just give the viewers a little bit background on you and Forum?
Sure, thanks. So as you mentioned, I'm the Chief Investment Officer here at Forum. We're in Denver, Colorado. Forum is a private equity real estate investor and lender. We are focused on multifamily, so we're an owner, we're an operator, we're a builder. We have an in-house development team, and we also lend to those like us who own and build. We do it through a number of different structures, both direct and funds, and that's sort of the nature of we're intentionally able to invest up and down the capital stack, and in the multifamily focus geographically. We do have a lot of investments in Denver, but we're diversified across the U.S. and have investments all over the country.
So when you think of real estate, I get that question all the time, right? Advisors are thinking about real estate today. There's obviously multiple verticals of how do you think about it. You obviously spend a lot of time in multifamily. Why that category, and how are you thinking about it in today's marketplace?
Yeah, so multifamily, my background actually is in multi-sector investing. Before Forum, which I joined almost 2 years ago, I worked in San Francisco, worked for a global bank, and ran a close to $25 billion fund that was multi-sector. And in choosing to come to Forum, it was intentional to focus on multifamily. And the big difference in multifamily and the other three sectors, and let's back up a step. Real estate in general is divided into four sectors. There's industrial, which is your average warehouse, big and small. There are apartments, which we focus on. There's retail, which is everything from your local grocery strip center to a giant regional mall. And then there's office, which we're all familiar with and is probably making a lot of the headlines. So the big difference in multifamily and the other asset classes is the lease term. They all have lease terms. Typically, in an apartment, it's a 1-year lease term. Probably many of your, if not all of your viewers have been an apartment dweller. They know what that's like. And so the lease resets every year. And if you're an owner, that means you have leases resetting every month. So one thing that's unique to multifamily is it gets the current market rent flows up into the property all the time. In the other asset classes, the leases are anywhere from 3 to 15 years in general. So whatever your top line revenue is reflective of market rent at whenever you cut that lease. And so that's a big difference. So the NOI change can be very chunky as the leases roll. So that's the easiest way to think about it.
So said in simple terms is you get to reset the market every year, right?
That's right.
If the market's up, rents are up. If the market's down, rents are down. But you get to reset it.
That's right. And you also keep it. You have the opportunity to keep it occupied. So when a lease rolls in one of the other asset classes, you've got to find another tenant, and it could be. You could roll right into another one, or it could be a couple of years till you find it. You can always rent a vacant apartment. You just set the rent at the right place, which is why the sweet spot for apartment occupancy isn't 100%. It's like 93, 94%, because if it's more than that, you're not charging enough, and if it's less than that, you're charging too much.
Yeah, and you love the sector. You're obviously sitting in the seat that you are because you love the sector, and I think that's a really good comment on things are resetting themselves on an annual basis. If as you know, most of the people that are watching this show are going to be advisors, and they're going to think about taking money from their clients and investing in the space. Can you just talk the viewers through a little bit how they should think about it? It may be direct deal, it may be fund, it may be category three, a mixed use kind of thing. How, if you're an advisor today who's watching this, would you coach them on how they would invest in the multifamily space?
Sure. So in general, the multifamily space as a real estate subsector is about that steady cash flow. That's the main feature of multifamily. Now, as you mentioned, it's market reflective. So you get whatever the current market is, but still it's steady. It's not chunky. So that's the main thing. When it comes to structure, there's the investment and then there's the structure, a direct deal versus a fund. This is true for real estate generally. A direct access into a specific deal, you get that transaction's performance. In general, your money is tied up in that investment for the duration of that hold, and there'll be a strategy around that, but it could be anywhere from investing to rehabilitate it and then selling it, or it could be a long-term hold where the sale and the liquidity related to that is undetermined. A fund is different in that you're investing in a whole lot of properties all at the same time. You can typically add to that investment anytime you want. You can get a form of liquidity in most cases. It's not anywhere like daily liquidity. It's not a stock, but there is a mechanism that by which over time you can get liquidity at your choosing. So a fund gives you diversification and this kind of liquidity both coming and going. A single investment gives you the characters of that investment and potentially more limited liquidity. But they both have their positives and negatives. If a single investment is a really great investment, you get 100% of that return. If it's part of a diversification, it's diluted by the diversification. And so I think that most investors, certainly the advisors, understand the benefits of diversification and the limitations of it. And I think that's the easiest way to think about it in structure. And then as the asset class in particular, it's about cash flow. It's about always being full, always having income coming off the property. That's what distinguishes multifamily from other investment classes.
Now, how do most people think about tax advantages, disadvantages?
Sure.
How should advisors think about investing in this category as it relates to taxes?
Well, real estate in general, and I was a lawyer at one point in my career, but not a tax lawyer. So this is the basics on real estate and taxes.
I think you're the first lawyer we have had on because we're
Wow,
anti-lawyers. No,
Jays and lawyers. I'm setting. I hope there's a
I'm,
plaque
I'm
up there
kidding.
with me in the top nameplate.
Yeah.
The real estate, as far as the tax code is concerned, real estate is very favorable. There's a tax policy way back when that encouraged investment in real estate, and so there's depreciation, which cuts your tax liability. There's also the ability to defer your capital gains through a 1031 exchange. So as you can roll a direct real estate investment into another direct real estate investment and defer capital gains potentially all the way through to your heirs and never pay it at all when you get a stepped up basis. So real estate is a great tax strategy engine because you can minimize your taxes through real estate. And so that's something that I think maybe one of the most well-known things about real estate actually is the tax advantages of it.
Well, I think the 1031 thing is I think most people know about accelerated depreciation, but I'm glad you brought up the 1031 exchange. I just don't think a lot of people know about that. And I think
it's a great feature. And 1031 is the tax code section that it refers to. So that's why it's called 1031. But it says that as long as you can sell a property, and as long as you take the proceeds from that sale and invest it into another property, whatever gain you made carries over into the next property. In other words, your basis stays the same, and you defer the capital gains on that gain. Now, warning, I see a lot of investors that are way down on the 1031 train, and their basis is almost non-existent effectively.
Yeah.
And an investor can get very focused on protecting that tax advantage and forget that the investment still has to be a solid investment, and they will overpay in order to protect the game. And that's fine as long as that's not great, but if it's all equity, that's fine. But a wrinkle to this whole thing is that if, God forbid, you were to put a loan on that property at some point and then something really awful happened and you lose the property to the bank, not only is your equity gone, but all that tax liability shows up at the same time. So it's worse than losing your equity. So again, not tax advice, but just tread carefully in the 1031 world and just make sure the investment you're rolling it into is a strong investment.
Well, and you're a lawyer by background. I'm a CPA by background, not a tax guy, but I always said it's great to save the taxes, but don't let the tax tail wag the dog, because if you make a bad investment, it doesn't matter how much you save on taxes.
I know. I love the 1031 program, and I also know many successful real estate investors that just pay their taxes every time. They sell it, they pay their capital gains, and they move on to the next one. So it's up to the investor.
That's awesome. Well, Jay, I always ask people, because I always have great guests like you. I always ask a personal question to end the show. Where are you traveling this year? Any cool plans with the family?
Yeah, we're probably going to stay on in the Western U.S. this year. I'm hoping to get maybe some beach time in San Diego. We'll definitely here in Denver. We'll definitely spend some good mountain time up in Vail, and we've got a trip planned down to Crested Butte. We're just, it's just too easy here in Denver to get access to the mountain areas, and we'll spend some time in Lake Tahoe in California too. So kind of local-ish travel here in the beautiful Western U.S.
Well, that's fantastic. Well, thanks again for joining. And how do people find you? Obviously, if they want to invest or want to talk to you at Forum, you and your team, obviously, I think the world of your team. How do people find you to talk about whether or not they should do business with Jay Miller, the team, in Forum?
Yeah, well, they certainly can find us on the internet at Forum Investment Group. They can definitely. I'm on LinkedIn, Jay Miller on LinkedIn, and you'll see a lot of what we do there posted as a part of my LinkedIn account. And so I think those are probably the two easiest ways to get to us. Or they can just call you, Jay. You know where to find us too.
Yeah, I know where to find you.
Yeah.
Well, Jay, thank you so much for joining me, and I really appreciate it. I hope you agree to come on to a future episode.
Absolutely. I appreciate the opportunity. Good to see you.
Yeah. Well, thanks for watching this week. Thanks again to Investopedia for their partnership on the Deep Dive podcast. We'll see you next time on the Deep Dive.